So you guys would remember that in Tuesday's lecture we started off, compiling this cost, right? This inventory cost. Let's just have a look at our roadmap and where we're at. So on Tuesday's lecture we started talking about inventory as an asset, and we said we defined it as an asset, we placed it as a current asset. And then we briefly spoke about periodic versus perpetual systems. We didn't do a lot of work on periodic. However, we said that perpetual is super important, and that is the important section for back 200. So just keep that in mind. Then we started with the calculation of the costs for the various categories of inventory. We started off by just discussing this idea of a purchase cost. And remember, we said purchase cost, and the principle that we learned there, in fact, for the whole of the second outcome, the entire of the second outcome, the principle that we learned was that we want to include costs that are incurred to bring the inventory to a sellable state. A sellable state means a state in which it can be sold, right? So costs that need to bring it to a state in which it can be sold must be included. Okay, can someone just answer Kyle there? I think he might be having some technical issues. So the key principle, and you need to write this down somewhere, the key principle is that we need to be able to include costs that bring the inventory to a sellable state. That's the key. It must be a sellable state, right? So that's the principle. That's what we want to try and apply, right? And so if we write down that principle and keep it at the back of our minds, what that can do is it can actually help us when we're in sticky situations and we don't understand, and when we're getting confused. We need to ask ourselves, is this cost incurred, or should this cost be incurred to bring this item to a sellable state, right? And then if it is, then we should try and include it in the cost of inventory, and if it's not, then we shouldn't, right? And you're going to see how this plays out today when we start talking a bit more about conversion costs. Okay, so that's what we did, and then we said so transportation inbound is included because it's a cost that we incur when we bring it to a sellable state, but not transportation outbound, etc. Right? So that was that. And then today we're going to talk about conversion costs. So conversion costs are those costs that are outside of the purchasing. So anything that happens after we've purchased the goods and after the goods have arrived at our factory, right? So all the costs that lead up to the goods arriving at our factory are considered purchase costs. When they're in our factory and now we're doing something with them, we are converting them. Those are called conversion costs, right? So the act of doing something with the goods, like manufacturing, like changing the format, like changing the form of the goods, those are conversion costs, right? And so we're going to deal with that today. We're also then going to touch a little bit tomorrow and in the coming days on other costs. This section here we said is self-study, right? So we will deal with it a little bit in class, but FIFO and weighted average and specific identification is going to be the majority of it is going to be self-study. We're just going to touch on important points in class, and that's going to happen on Tuesday in lecture 5. But the key between lecture 5 and 6 is this idea here, this net realizable value. That is the important bit. That is the bit that everyone misses, and that's the bit that we're going to focus on next week, Tuesday. And so that's super important part of this topic. Okay, and then finally on Thursday next week we will do a little bit of disclosure. Remember, we are doing disclosure for inventory, and so we'll do that. And then the Friday, which is the last lecture for inventory, is going to be a big example that we need to do. And you guys can download that example from ClickUp if you want. Okay. So that's our map. So currently we're still sitting in conversion costs. We're still here in number 2. And let's see how far we can go today with that, right? So conversion costs, like we are talking about, right? So conversion costs are the costs that are incurred in the manufacturing process, right? When we're doing something to the raw materials in order to arrive at finished goods, we consider that conversion costs. Okay. Now, the question that I have for you is, let's say we go and purchase raw materials, right? Can we call those raw materials, that cost of purchase for the raw materials, can we call it a conversion cost? Your answer in the chat now. So is the cost of paying and purchasing raw materials, is it a conversion cost? What do you think? Yes or no? Okay, that's correct. Most people are saying no, it's not a conversion cost. That is a purchase cost, right? A conversion cost has to be the doing of something, the converting of something. So if we have a look at where conversion cost sits, right? We have direct costs, which we sometimes refer to as purchase cost, right? That's the cost of purchasing. That's the transporting of the raw materials. That's the bringing of the raw materials to the warehouse, to the storeroom. That's all of that happens there. And then separately, we've got this other thing called conversion cost, right? And so we add the both of them up, and then later on we'll add this one. The other costs. And then we're going to get the cost of the inventory, right? But for now, let's focus here on conversion costs. So the conversion costs are added to the purchase costs, right? And so the question then is, what exactly does this amount include? We know what purchase costs include. We know that it includes transport, inbound, it includes a cost of inventory, import costs, all of those different things, right? We must remove things like forex gains and losses. We must remove any abnormal wastages that have happened during transportation or whatever. So that's what's in purchase cost. But what's in conversion cost? So the first thing is we do have some other additional costs, right? And for example, some other ones are going to be the direct labor, the wages of the factory workers, right? Why do we say they are direct? Because the link between that cost and the manufacturing of the goods is very strong, is very clear, right? So you're going to see, I'm going to start talking about variableness just now, and directness. So there's a difference between the two um, things. Now, the way I like to describe it is, if you say, someone is a tall man, right? So he's a tall guy, he's a tall man. Does that describe his weight, right? And the answer is no, because you can have a tall person that is thin, or you can have a tall person that's overweight, right? So what we've seen here is that weight, right? The weight of someone is a different characteristic from his height. They're two separate characteristics, right? Can we understand that? Does everybody understand that? The weight the weight of someone and their height are two different characteristics, and they don't necessarily have to go together, right? Does that make sense? Okay. In the same way, when we're describing costs, we can have costs that are either direct or indirect, right? So this is indirect costs on the side, on the right hand side. We can have direct costs or indirect costs, right? Direct costs often will vary with production, right? So that's okay. But indirect costs can be both variable and non-variable or fixed. Another word for non-variable is fixed, right? So here, I don't want you to get confused between a variable and indirect, right? You can have an indirect cost that's variable because it's describing a different element of the cost. So what is direct versus indirect describing? It's describing how closely linked this cost is to the manufacturing process. So you need to ask yourself, what is the link between the cost and manufacturing? And if it's a direct link, if it's closely linked, then we consider it a direct cost. But if we've got a cost that is not direct, it would be an indirect cost, but that does not mean it doesn't need to vary with production, right? Because the discussion between variability and fixed costs, that asks, how does this cost react when we change production? What is the effect on this cost when we change production, right? And so we can have variable and fixed manufacturing overheads or manufacturing costs. And that's what we're going to deal with today. So just to reiterate, the next few slides are just going to be sort of a repetition. I sort of jumped ahead a little bit while talking on that slide. So someone has a question. Yes. You can put your mic on. Has the question disappeared? The question asker has disappeared. Okay. Okay, so variable costs, like we said, change with the level of production, right? So that's the idea behind variable costs. They change with the level of production. Okay. So that's what I'm trying to say here. I'm also trying to say, just remember this idea of normal versus abnormal spillage, just because I think a lot of people are going to forget. Remember, abnormal spillage we don't include in the cost of inventory, whereas normal spillage we do. That's just an aside. It's not the important bit of the slide. Okay, so now what I'm trying to say. So we are on page 687 there. So what I'm trying to say is that we've got this variable costs that actually change as what you call it, manufacturing changes, and then we've got these fixed costs, right? These fixed costs, and they do not change. Okay, they do not. They stay stagnant as we change the level of production. They stay the same as we change the level of production. And then I want to talk about this other topic, right? So in a business, so far we've only been talking about manufacturing, and we've only been talking about the factory and that sort of stuff. But in a business, there's generally other types of costs that come about. So there will be a cost to pay the financial accountant. There will be a cost to pay the cleaners. There will be all of these additional costs, right, that are not related to the manufacturer at all, right? So now we've got a third category. So we've first got direct costs, right, which are direct labor, direct raw materials, direct materials. So we've got direct costs. Then we've got what we call the indirect costs. And remember, the indirect costs are broken up into variable and fixed. And then we've got a third category, which we call non-production costs, right? These costs are not related at all to production. So they're not even indirect. They're just not related, right? So there's three sort of levels of directness. We've got direct costs, indirect costs, and then non-production costs, which are not related at all, right? And so these costs that are not related at all are not included in the value of inventory. So let's just look at that in a slide. So I say when we have overheads, we sometimes get production overheads, and then we get non-production overheads. With production overheads or manufacturing overheads, we include it in the manufacturing process, right? And the reason why they were incurred was somehow related. They were indirect, but they were related to the cost of the manufacturing process. These the non-production overheads were not incurred in relation to manufacturing. They were incurred to some other process that happens in the business. Because the business is big, there are other things that happen in the business, such as accounting, such as lawyers, such as, all of these other things that happen. And these non-production costs were incurred because of that, right? And so we say it's going to be the salary of the accountant, it's going to be the selling of the goods, it's going to be all of these other things, like maybe a rent for the office block. Those are going to be the non-production overhead. So there's no relation between these costs and production. Between non-production overhead costs and production, there's no relation. But with the production overheads, there's an indirect relationship, right? And so, for example, those are going to be the factory, rental for the factory, any sort of production machinery that needs to be depreciated, any sort of indirect labor or indirect materials, right? And so what we do is we allocate these production overhead costs to the value of inventory, right? And then we eventually, once the inventory is sold, we will move them into cost of sales, right? And so what we're doing here is we're actually trying to protect the cost of sales, right? Remember when we were doing revenue last week, we were saying to ourselves, we want to protect the revenue. We want to make sure that the revenue amount is not overinflated. Remember that story? We said we want to make sure the revenue amount is not overinflated. Now, because we've done all of that work on revenue, right? And cost of sales is going to be used to calculate this other figure called gross profit. We also need to be careful about what we put into cost of sales. We can't just put everything into cost of sales. So this exercise that we're doing here, this exercise where we're splitting the indirect costs between production overheads and non-production overheads is where we're actually trying to protect that cost of sales. So we don't want to overinflate that cost of sales either, you see, because then we're not gonna be comparing apples with apples. So we've done our work on revenue. Now we want to protect the cost of sales. And the way we protect the cost of sales is by protecting the value of the inventory, because that value eventually will become a cost of sales amount, right? So with the non-production overheads, we do not include it in the cost of inventory. We do not include it in the cost of products, right? And therefore it sits in accounts under other expenses. So they can be administrative expenses, they can be other salaries, and they will go under other expenses. So they're non-operational expenses, right? So that's what will happen. Someone asked, is electricity variable or semi-variable? The answer to that is it actually depends on the entity that we're dealing with. So if we're dealing with an entity that uses electricity in the manufacture process, as opposed to using some sort of other energy, right? Then we can say, yes, it is variable, because as we produce more, the cost of the electricity that we use, or the amount of electricity that we use, will increase. So it's variable, right? It would be variable with production. Okay. So here I'm just again reiterating where we are on our map, right? So we've already done purchase costs. We're here in conversion costs, and we're specifically looking at the split right here at the bottom, right? We specifically look at the split between the two. So this is just a rehashing of the diagram that we see in our books. Okay. So now I want to start talking about. So we're still dealing with overheads. We're still dealing with indirect costs. We're still dealing with variable versus fixed, right? So we're still there. Now the question I want to ask you is, can you see that if we have a variable cost, it is easy for us to allocate or appoint that cost to a specific unit of produce or a specific good, right? So let's say we're making laptops, right? And just like Benjamin is saying in the chat, let's say we're making laptops and the laptops require electricity. So we made one laptop and we paid 10 Rand electricity. But then when we make 10 laptops, we now pay 100 Rand electricity. So we pay more electricity because we're using electricity in the production process, right? So it's variable in relation to the amount of goods that we have produced. So it's a variable cost, right? So now how would you allocate that electricity? You would say, I've produced 10 laptops, right? And I paid 100 Rand of electricity. So wouldn't that make sense then to say, because I've got the actual cost of electricity and the actual production, wouldn't it make sense if we just took the cost, which is 100 Rand, and divided it by 10, and then said, when we're doing our costing for the laptops, each laptop needs to attract a cost of electricity of 10 Rand. That's how much it cost us to get to that electricity. Does that make sense? Just give me a thumbs up if you understand the relationship between variable costs and the costing of the inventory and the allocation of the inventory, right? So it's easy to allocate variable costs, right? The idea is that it's easy to allocate variable costs, and the reason why it's easy to allocate variable costs is because as production changes, right, the cost changes. And so it's super easy to say, okay, because the cost has changed and we've produced, X number of products, therefore we can allocate the cost easily. The problem with fixed, so that's variable, right? So we've spoken about variable. So now let's talk about fixed costs. The problem with fixed costs is it doesn't change, right? It doesn't change with the level of production, right? Which then means, how do we allocate that cost? Now let's just park here and let's just visualize, let's just think about this, right? So let's say we pay 1,000 Rand for our factory. Okay. Now on day one, I've produced one laptop. On day one, on the 1st of January, I've produced one laptop. Would it be fair for me to allocate that 1,000 Rand of rental to that one laptop? And the answer is no. So why wouldn't it be fair? Because on day two, I'm going to produce another laptop. So then, I've already allocated that cost to laptop number one. Does that mean laptop number two doesn't get any cost for rental? That's the conundrum that we're sitting with now. We sit with a situation of what is the best way for us to allocate the fixed costs, right? And so the best way, there isn't a direct method like with variable. Variable was easy. We could figure out a method pretty quickly. With fixed costs, there isn't that direct method, right? And so today, later on in today's lecture, we're going to start discussing a method of us to allocate this cost. So I just want you to think about that, and then we'll return to this problem a bit later on, right? We'll return to this conundrum a little bit later on. I just want to show you what a fixed cost versus a variable cost looks like on a graph. For those that are doing economics, this will be very familiar to you. On the x-axis, we've got the level of production, right? And so as the level of production increases, we find that there's an increase in variable costs. Now, this is not, it won't be a 45 degree relationship, right? But there is some relationship that happens here, right? Between production and the cost that we have incurred with variable costs. With fixed costs, so this is what I'm talking about. With fixed costs, as we increase production, the fixed cost doesn't change, right? And some of you may also talk about, and I think that's what Benjamin was talking about just now, a step cost. So a step cost is a cost where from 1 to 10 it's okay, but then it goes up from 10 to 20, then it goes up like that. So you can also have that sort of step cost where it's sort of variable, but also sort of fixed, right? And so those costs do exist, But for accounting for this year, you're not gonna get any of those costs, right? I just want to acknowledge that you will see that in some of your other subjects, but for accounting, we won't deal with that just yet. Okay, so just be aware that does exist. Okay. So now let's see if we can classify some costs. Right. So we've got depreciation on factory equipment. Right. So we've got depreciation on factory equipment. So is it a production cost? Yes. Right. So we see here it is a production cost. How do we know that it's a production cost? What word is telling us that it's a production cost? What do you guys think? What word lets us know that this depreciation is a production cost? What word? Yes, that's the word. The word factory tells us that this is a production cost, right? So when we're reading our tests and exams, we need to be looking out for words like factory, like manufacturing plant, which is the same thing as factory, right? So manufacturing plant and factory are the same thing. So those are the words that we need to be looking for to identify if it's a production cost or not. So if we were to change this word factory and say sales, what happens then? It becomes a non-production cost. You see that? It becomes a non-production cost. Why? Why does it become a non-production? What's the reasoning? Remember the principle. This cost would have not been incurred to make the product sellable. Can you see the relationship? Can you see the relationship back to our principle? Our principle was we want to include costs that make that provide a sellable final good for us. Now, the selling equipment, right? Let's just assume there was a selling equipment. The selling equipment is not making it sellable. It was already sellable before we sold it. That's why we were able to sell it, because it was sellable. If that makes sense. Okay, not related to the production of inventory. Correct. It's not related at all to the production of inventory. All right. So now, wages paid to cleaners. Notice what it adds at the end. Factory, paid to cleaners in the factory. Therefore, it's a production cost, right? And then obviously consumables used in the factory. Again, it's a production cost because it talks about something to do with production in a factory. So if we have a cleaner that does 60% of the work in the factory, and the other 40% they clean the finance department, then we would have to split that wages. 60 goes to the production, and the other 40 goes to non-production or goes to other expenses on the income statement. Can you see that, right? So there might even be a situation where we have to split these costs between production and non-production. Now let's just talk about fixed. Remember, we talk about different characteristics of the cost, right? So fixed, we'd say depreciation is fixed. Why? So in our example here, we will assume that the depreciation is calculated on a straight line or diminishing balance method on the time, all right? On the amount of time that we used, the amount of time that the equipment was used. So we're not dealing with a situation where depreciation is based on units produced. You know, you can have that where depreciation is based on units produced. So we're not dealing with that situation. Here we're only dealing with where the depreciation is based on time. So you say, or 10% every year, or whatever, you know, however you decide to calculate it. But it's based on time as opposed to production, right? So then it's fixed. So that's fixed. Wages for the factory cleaner. So the question that we need to ask ourselves is, if we produce more, will the factory be more dirty? And then the answer is probably yes, it will be more dirty. So we will need more of the cleaner's time. Or you can even ask yourself, you know, if I were to add an extra shift, if I was increasing production and now I had to add an extra shift of workers in the factory, would I need an additional cleaner? And again, the answer is yes. So can you see how it varies, right? That cost varies with the level of production, right? Similarly to, for example, a manager, you can say, okay, a manager is more like a step cost. So a manager, if I have more equipment, more machines, and more workers, would I need an additional manager? And the answer is yes, but only at a specific point, only when it gets to a specific size where one person can't control it, right? So similarly with a manager will also be a variable cost. And then consumables, I don't think I need to explain it. You can think of it like the plastic bags at Checkers. The more Checkers sells to you, the more plastic bags they're going to need, right? Does that make sense? So that's basically those costs. All right. So let's just do a quick check as to where we are. Where are we in the grand scheme of things? So we did purchase costs in Tuesday. Labor costs, we sort of dealt with direct labor costs. We sort of dealt with tacitly, where we said that if they're directly linked, we need to include them because they're going to be included in the production. Now, variable manufacturing overheads, that's going to be the cleaners' salaries, that's going to be the managers' salaries, that's going to be the electricity, that's going to be those things, right? We'll go on to variable. And then fixed, for example, we said fixed can be like rental, right? So this looks very much like a what statement? I'm not going to give you the answer. You must think what something statement you guys learned in. You guys have learned about this already. Okay. Yes, that's it. Looks very similar to a production statement. Okay. Okay. So let's just talk again about that problem that I spoke to. Can you remember I spoke to you about a problem with fixed costs? Let's just come back to that and revisit that, right? So we said when we have variable costs, it's easy for us to allocate and pinpoint how much of the variable cost needs to go to individual units, right? We said if we had 100 rand, if we had 10 rand when we produced one laptop, and then when we had 10 laptops, we had to pay 100 rand. That means it's 10 rand per laptop, roughly. So roughly 10 rand per laptop. So therefore, we would say in the costing, in the planning about how to sell this laptop, we would say, okay, we must include 10 rand of electricity, for example, right? But now, how do we include rental, right? And we said it doesn't make sense for us to include all the rental on the first one, nor does it make sense for us to include all the rental on the last one, or anything, or any individual one in between. But the thing is that we must find some way to allocate this fixed cost to individual products. Why do we have to find some way to do that? Because if we don't do that, that means the cost that we hold the goods at, the cost that the goods are reflected at in our income statement, in our balance sheet, will be incorrect. And therefore, we cannot make decisions with incorrect information. Right? So we have to find some way to allocate it. So the way that we have found and the way that we're going to do is we need to come up with an estimated, right? An estimated production number, right? So an estimated units that we've produced. Does that make sense? We want to come up with an estimated units that we're going to produce for a given period, right? So let me just talk to you about the difference between estimated and actual. So actual, we call it actual capacity, what has actually happened in a given year. Someone has said yes. I wonder if it was to one of the questions that I asked. An actual capacity is the actual level, the actual number of units that we've produced in a given year, right? Now, when will we know that number? When are we going to find out about that? What time of the year? At the beginning or the end of the year will we know the actual number? Type out in the chat. When will we know about the actual number that we've produced? Right? The only time we're going to find out about it is at the end of the year. But we need to be able to allocate that cost during the year, right? Okay, guys, so everyone's got it. The actual number we're only going to find out at the end of the year. During the year, we need to allocate the cost. So we come up with what we call normal capacity. Another word for normal capacity is the estimated or expected capacity, right? So this is a number of units. These two things are numbers. Actual capacity and normal capacity are expressed in units. So they're not rands, right? They're not rands, they're not cents, they are units, right? So units produced, okay? So normal capacity is our best estimate of the number of units that we're going to produce, you see? This is what normal capacity is. It's our best estimate of the number of units that we're going to produce. And we use that to now allocate the fixed costs, right? Because remember, the fixed costs are easy to predict. The fixed costs are easy to predict. Why? Because they're fixed. They're not going to change. So at the beginning of the year, we can say, okay, I think this is how much rent is going to cost me for the year, right? And that's an easy thing to predict because they're not changing. It's not changing with production. And then I allocate it to individual units based on the normal capacity, right? So I allocate that cost and I say, this first unit that I produced is going to have so much rental allocated to it, right? And I do that based on normal capacity. And another word for normal capacity is estimated or budgeted units that I plan to produce. Okay, so this is what I'm saying in this slide. I say the actual number of fixed overheads. So the fixed overheads, for example, rental, is easy for me to estimate, right? And the reason why it's easier for me to estimate is because I can do a calculation on it because it doesn't change. The problem is really this number of units, the actual number of units. I can't predict it at the beginning of the year, and I will only know at the end of the year, right? I will only know at the end of the year how much I produce in total, right? So that's what that is saying. So I need to find a way now to allocate. I need to find a way to allocate the fixed overheads to the individual units, right? Because I need the individual units to have a cost because that cost helps me to make decisions. So what do? I come up with my best estimate, right? I come up with the best estimate and the number of goods and the best estimate of the number of goods, the number of units that I plan to produce, right? So that's what I do. And I take the overheads, which we just said is easy. So the overheads will be in a rand amount, and I divide it by the number of estimated goods that I plan to produce for the year, right? And the result, the product of this calculation is going to be what we call an application rate or an allocation rate. It's the rate or the cost of fixed goods that we can allocate to individual units. Let me give you an example, right? So this is an example, right? So maybe this will help you guys to understand it more in depthly. So we say last year we paid rental of 100,000 last year, right? And we know that rental is going to increase by 10%. So our rental cost for this year is going to be 110. Okay, so let me explain it again. Last year the rental was 100,000. We're going to increase it by 10%. So we increase it by 10% and we say this year it's going to, so 2022, it's going to cost us 110,000 rand, right? So that's a rand amount. Now let's classify that cost, right? So is it a direct material or a direct labor cost? Answer is no, right? So it must be indirect. So this is rental for the factory, right? So it must be an indirect cost, right? So is it variable or is it fixed, the rental? Is it variable with the number of goods we produce or is it fixed? So you need to ask yourself, right? You need to ask yourself this question. When you make food at home. So you're sitting in your residence or your dormitory and you're making food, right? You're making your food hot. Now let's say you eat 6 meals a day. Does your landlord charge you more because you eat 6 meals a day? Your answer, no. Right? Your landlord won't charge you more and say, oh, you know, the other person, he only eats 3 meals a day. So I must charge you 6. They must charge you extra because you eat 6 meals a day. That's not how it works, right? In the same way, what we can see here is the rental doesn't change with the level of production, right? The rental is not changing with the level of production, right? Just as an aside, so the rental is fixed, right? Now, using that same example, I just want to stop there and I want to talk about another cost, right? Let's just park this example now for a few seconds. I just want to, so if everyone's okay, we're just going to talk about electricity. So with electricity, if I make 1 meal a day, right, and then my friend makes 6 meals a day, right? Can you see that my friend is going to pay more for electricity? Does that make sense? Because he's making more food, right? Does that make sense? Right. Now, the next question I want to ask you is, in the final product, in the food that's sitting on the table, can you see any electricity in the food? And the answer is no. So electricity would be indirect, would be an indirect cost because it's not directly linked to the final product, right? You can't directly link it, but it is variable. So that's an indirect variable cost. Does that make sense to everyone? Electricity would be an indirect variable cost. Just tell me if you guys understand. Electricity would be an indirect variable cost, whereas rental would be an indirect fixed cost. So rental is fixed, the electricity is variable. Okay, cool. So now what do I do? So anyway, back to our example. Let's come back to our example. We took a small tangent there, but I want to come back to our example, right? So we have this fixed cost, the rental, right? The fixed cost being the rental. The rental has increased by 10%, so we got a amount for the current year of 110,000 Rand. Right. Now we estimate that we're going to produce 50,000. We estimate that this is normal production. The normal production is 50,000. That's what our estimation is. So we take the 110 divided by 50,000 units. Notice what I said. I said the capacity is always displayed or always spoken about in units, right? So 110,000 divided by 50,000 units, that's going to give us an application rate or an allocation rate of 2 Rand 20. This is the rate that we now say, okay, we've got 10 units, right? We've got 10 units that we've produced, 10 laptops. Therefore, we need to allocate in our general journal. That's too high, isn't it? What is going on? Why is my brain not working? I had to use the calculator. Can you believe it? Right. So we would allocate 22 Rand of rental to those 10 units. Does that make sense to everyone? I need you guys to tell me if you understand. So there's no use us going any further if people are not understanding. Let me have a look at the chat. So we say, there's a question in the chat saying, so when we allocate the WIP, we take the rate multiplied by the normal production. No. So in order to arrive at the rate, we would take the cost, divide it by the normal capacity, right? And that's going to give us a rate. And then we multiply that by whatever number we produced, whatever we actually produce. So we use that rate as an allocation to the number of goods we've produced. So in month one, if we only did 10 goods, and we were supposed to do 50 for the year, right? And in month one, we only did 10 goods. We would then say 2 Rand 20 multiplied by 10, because that's what we produced this year. And that is the cost that we will now allocate to work in progress. Does everybody understand that? Just give me a thumbs up if that makes sense. So we take the rate and we multiply it by the number that we produced in a given month or a given day or a given week, right? Depending on what the accounting cycle is like. But generally, it's going to be on a monthly basis. So in month one, I only produced 10 laptops, and therefore I'm going to say 2 Rand 20 times 10. I'm going to allocate 22 Rand into work in progress, right? So it seems like everyone's on the same page. It seems like everyone understands. So this is we just need to cover this last point and then we can move on. So I want to talk about the difference between incurred and allocated costs. Right? Incurred costs means, and because we're using the accrual principle in accounting, incurred costs means costs that we need to pay, right? Or costs that have been paid, right? So when your landlord sends you an invoice for rental, that is incurred, right? But you have not yet allocated it to the different food products that you've made, right? That is incurred. So what you'll find is incurred costs. If we had to have like a fixed production overheads account, let's assume this is a rental account, right? This can be sort of any account that is fixed production overheads. So in a T account, we would then debit the T account, right? And we would credit bank, or we might credit creditor, or we might credit expense paid in advance or accrued expenses or whatever, but we would debit it because we incurred it, because we need to pay it, right? That's incurred, right? But then we're going to remove it out of this expense account and put it into work in progress, and we're going to do that by the number of units that we produce multiplied by the allocation rate. So in our previous example, the allocation rate was 2 Rand 20, right? So this journal entry on the credit side would be for an amount of 22 Rand, right? So there's a difference between costs that have been incurred. Costs that have been incurred are costs that we need to pay. Costs that we have allocated are costs that we've taken out from expenses and we've now put it into inventory or work in progress, which is an asset. Does that make sense? We've taken allocated costs, we've taken it out of expenses, and we've now put it in and we transferred it into work in progress, right? So that's what, when you do that exercise, you say you are allocating the cost, right? You're allocating the cost to a specific unit that you've produced, right? So that is what allocated means, right? So I don't want you to get confused. The problem is when you look at your tests and exams, you're going to see these words incurred versus allocated, and it's easy to get confused. So I want to be very clear in the difference between incurred versus allocated. Incurred is cost that we need to pay, and that might be as a result of the accrual system, whereas allocated, right? Allocated with an A. Allocated is cost that we've transferred to the asset. Does everybody understand the difference between incurred and allocated? Give me a thumbs up if you understand what incurred means and what allocated means. Okay. Cool. Okay, guys. So we're going to leave it there for today. And the reason why we're leaving it there is because I think we've covered this tricky topic of fixed overheads. So I want you guys to really think about that and meditate and let it marinate in your head, and then we'll return to it tomorrow with a bit more examples. Okay, so someone's just asked in the chat, please can you explain what allocated means again? So incurred, I think you're happy with incurred. Incurred means, I'm actually going to stop the recording because our lecture is basically over. We can do